For most of us, a pension plus a stocks and shares ISA are the only accounts that we're likely to need to build wealth for the future. But what if you're bumping up against the pension lifetime allowance? What if you're a high earner and your pension annual allowance is tapered to next to nothing? What if you've had a windfall or a big bonus and you want to save a ton of tax? In this video, I'll explain the alternatives to pensions and ISAs. Stay tuned till the end though, because I'll share when each of them might be the most useful. Hi, welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Build Wealth. More on that a bit later. So you might be surprised if you knew just how many emails I get from folks who are looking to learn about what's next once ISA and pension allowances are fully used up. Like I say, often these are high earners, but not always. Sometimes they are folks who've just received a big promotion or a bonus, or maybe have sold a business and are then faced with a large tax bill. So we're going to go over 4 alternative accounts to pension and ISA. They are general investment accounts, enterprise investment schemes, venture capital trusts, and investment bonds. We'll cover the pros and cons of each and their tax advantages or disadvantages, but we're going to start simple and work our way up to the more complex accounts. So let's start with a general investment account, and a GIA is about as simple as things get. You might see these called dealing accounts, trading accounts, or all kinds of other names, but basically it's just an investment account that isn't any of the other tax-advantaged accounts. You can hold pretty much any kind of asset inside a GIA, except maybe a physical property. But basically, if it's tradable on a stock market somewhere, you'll be able to hold it in your GIA as long as your platform offers access to it. If it's anything other than a mainstream fund, ETF, or share, you might struggle. There are no tax advantages to a GIA, except that because there's no tax advantages, they allow you to use the general allowances available. So you can offset capital gains that you make against your CGT annual exempt allowance, although thanks to Messrs. Sunak and Hunt, the AEA is going to be reduced drastically over the next couple of years. Dividend income can fall within your dividend allowance, and interest can fall within your personal savings allowance. You can have a joint GIA, so you can use your partner's allowances too. If you make a loss, you can offset that loss against gains made elsewhere or in the future. But there are no tax reliefs given for investing in a GIA. For that, we got to look elsewhere. And that brings us to enterprise investment schemes, which are an especially useful account if you have made an investment gain on which capital gains tax is payable and you want to defer paying that tax. An EIS is a wrapper. It's an account in which you hold qualifying shares. It's important to remember that, and I'll come back to why in just a sec. You can buy off-the-shelf, done-for-you EISs from investment companies. That's what most people do. You can invest a gain made elsewhere into an EIS, and you can defer paying the tax on that gain indefinitely, as long as the money stays within the EIS. You can defer gains made up to 3 years before your EIS investment and 1 year after. And the idea is that after you've held the investment for 3 years, you can sell shares in your EIS and do so within the annual exempt allowance and take them out tax-free. Or you could wait until you're a basic rate taxpayer and pay CGT at only 10%, not 20%. Of course, depending on the size of the gain, this might have to happen over many years. Any growth of the shares inside the EIS is free from capital gains tax. You can also get income tax relief of 30% of anything that you invest. So if you make an investment of £100,000, you can get 30 grand off your tax bill. That is, as long as you've paid that much tax in the first place. Again, you have to hold the EIS shares for 3 years. You get the relief right away, but sell within 3 years and you'll have to pay the tax. You can even carry back the tax relief 1 year, so you can get back tax that you've already paid. You can invest up to £1 million in an EIS per tax year, or even up to £2 million as long as the second million is invested in so-called knowledge-intensive companies. If things don't go well and the shares that you're invested in lose money, you can apply for loss relief, which offsets the loss, minus any tax relief you've already had, against your income tax bill. You can use your losses to reduce your income tax. And finally, EIS shares are usually free of inheritance tax if you've held them for more than 2 years and you still hold them when you die. Now, there's a slightly different version called a seed EIS with much smaller investment limit of £100,000, but the income tax relief is a massive 50%. You don't defer capital gains with a seed EIS, but you can halve the CGT that you owe. Shares held in an EIS are high-risk investments, and seed EIS shares even more so. And that's the point, right? The government is giving you all these amazing tax breaks to encourage investment in early-stage companies. But there is a very high chance that the investments will fail or be very illiquid. That means difficult to sell and get your money out. So, pros, loads of tax breaks. Cons, you might lose or be unable to access whatever you put in. Right, we're covering some serious ground here, folks. This is the deep end of the pool, but if it's helpful and or interesting and useful, do me a favor and hit the like button. Subscribe to the channel if you're not already. It really, really helps. Thank you so much for doing that. I'm going to move on and talk about venture capital trusts. Now, VCTs are not technically a wrapper as such. Instead, they are a publicly listed investment company run by a fund manager. The manager will aim to make you money by investing in small, early-stage, unquoted companies. The manager will usually have a portfolio of several investee companies, so you get some diversification. You get income tax relief at 30% again, but with a much lower limit than the EIS. You can invest up to £200,000 in any 1 year, potentially saving up to 60 grand in income tax. You got to keep the VCT for 5 years to keep this tax relief, though. Again, you get the relief up front, but cancel or sell your VCT shares within 5 years and you'd have to pay the tax. You can even roll over your money in VCTs. So if there's liquidity after 5 years, you can roll over the money and get tax relief again on the same money. Not bad. Any dividends that a VCT produces are tax-free, and there's no capital gains tax to pay on any growth. But you can't use a VCT to defer capital gains made elsewhere like you can with an EIS. And there's no inheritance tax benefit either. Again, VCTs are a high-risk investment due to the nature of the underlying shares. These are startups and growing companies. Yeah, you might 10x your money, you might lose the lot. And there's no loss relief with VCTs. Pros and cons are very similar to EISs, really good tax breaks, but highly volatile underlying investments. And there's a time limit to them as well. You have to leave the money in for 5 years. And so finally, we move on to investment bonds. Now, these are weird things. You don't hear about them that often, but in the right circumstances, they can be really useful. There are two flavors, onshore and offshore. I'll cover onshore bonds first and then go over how the offshore versions differ. At their root, they are a contract of life insurance, and they are issued by insurance companies. And because they are written under insurance law, they've got some weird quirks. So firstly, the insurance company pays tax on any income or gains made by the underlying investment. And that means that you are treated as already having paid basic rate income tax on that money. There are never any capital gains made on an investment bond. Capital gains tax does not apply. Instead, at certain so-called chargeable events, you might get an income tax charge, but only if that event takes you into the higher rate tax band. Calculations can be pretty complex. I won't bore you with them here, but it means that investment bonds can be a good place to park money and have it invested while you are a higher or additional rate taxpayer, until maybe later on you become a basic rate taxpayer, perhaps after you've retired. Worst case, you'd only pay 20% or 25% on any gains, not the full 40 or 45%, as the first 20% is paid for you, essentially. Chargeable events include death, transfers of legal ownership, the bond maturing, or you cashing in some or all of it. You might get something called top slicing relief, which spreads the gains over the number of complete years that you've held the bond. That depends on your taxpayer status, though, but you can withdraw 5% of the original investment each year without any immediate tax liability. I mean, you're drawing your own money out, that's all. But you can roll up those 5% allowances. So if you don't take anything out in years 1 and 2, you can take out 3 lots of 5%, 15% in year 3. That's onshore bonds. Offshore bonds work very similarly, except that the basic rate tax is not paid as you go along. Instead, gains and income on the underlying funds will be largely tax-free, except maybe for some small withholding taxes. And that means that all other things being equal, offshore bonds will likely grow faster because they're not paying tax as they go. But when you get a chargeable event, your tax will be higher. Offshore bonds are sometimes higher charging though, which can offset that benefit. One last point, investment bonds are often used inside trusts, which are really heavily taxed because they don't produce an income until a chargeable event happens. So you can plan your taxation to some degree. Okay, with all 4 accounts covered, we need to look at which might be used and when. But before that, let me just remind you that Meaningful Academy Build Wealth is designed to help you make these kinds of decisions for yourself without the help of a professional advisor. There are tons of video lessons in the Academy, workbooks, calculators, and access to the greatest financial planning software in the world, Voyant Go. It's super powerful yet easy to use, and I give you tons of help in learning to use it. Best of all, there's a community of hundreds of like-minded people all wanting to build wealth effectively and happy to share ideas, answer questions, and help each other out. So find out more at meaningfulacademy.com/buildwealth. And if you sign up, don't forget to use the coupon code YouTube for a deep discount. Right, now we know the basics of each of the 4 accounts. When might each of them be most useful? GIAs are best suited for those looking for simplicity. If you've got some tax allowances available, gains and income from a GIA will fit in there. You can dial up or down the risk of the underlying assets. Really flexible. For those who have got capital gains to defer, really an EIS is the only route. You need to be able to leave the money for 3 years to get the most benefit. If you've used up your pension allowance or are looking for tax-free income, then a VCT might be a good option. You'll likely get better diversification from a VCT than an EIS, so that might be a factor for you too. And finally, investment bonds can help you defer tax on income and gains made when you're a higher or additional rate taxpayer and allow you to take advantage of top slicing relief. Always remember that the underlying investments, particularly in EISs and VCTs, can be risky. So you'll have to weigh this against the potential benefits of each account. Now, remember when I said this was the deep end of the pool? Well, if you're in a position where you're considering alternatives to pension and ISA, looking at some of these accounts, it's a fact that you will almost certainly benefit from seeking professional advice. There are tons of pitfalls here, lots of tax angles you need to be aware of, so please tread carefully if you're DIYing this kind of investment. If you do want to seek advice, watch this video for 6 things you should know before you do. Okay, leave any comments and questions under the video here. I'll do my best to answer them, but I can never get to them all, unfortunately. Please like the video and subscribe to the channel if you're not already. Thank you so much for watching this one. I'll see you in the next video.